Hello and welcome to another edition of Investing for Generations. And today I want to analyze another stock out of my watch list and then also want to give you my weekly insight of my portfolio and see what happened there over the last week. So let's go. Today I want to talk about Alphabet, or better known as Google. Alphabet is a multinational conglomerate headquartered in Mountain View, California, and was created in 2015 in a reconstruction of Google, and it's now the parent company of Google. And Alphabet is really a conglomerate, of course, of Google and the different parts of Google, like YouTube, of course, Google Maps, and Google Ads, which is very famous, but also a lot of other companies under the belt of Alphabet. So this is really a big player, and of course, most known for the search engine of Google. Then take a deeper look into the financial numbers of Alphabet. Alphabet pays no dividend and have a very strong growth of revenue. This is a picture just over the last 20 years, and you see it just growing all the time. And lately, of course, because of the pandemic situation, the revenue growth declined a little bit, but even over the last 3 years, we had growth rates of 18, 23, and 22%. But in the future, at least when you look at the Yahoo Finance site, the growth will stop a little bit or even slow down. Yahoo Finance estimates a growth in the next 5 years of just a little bit over 6%. But we will come back to this number a little bit later when we evaluate the stock price. Alphabet runs on good high margins, and even lately with the pandemic and the problem with that, margins are still high. There's still an operating margin of almost 20% and also a net margin just slightly under 20%, which is really nice and just shows that Alphabet just makes money all the time. And the same picture we see when we look at the free cash flow. Alphabet have a very positive free cash flow every quarter. Then take a look on the balance sheet. And the balance sheet is super solid, as with so many of these FANG stocks. Just $14 billion of long-term debt, but $207 billion of equity. So this is almost nothing. This is a debt equity ratio of 0.07. And also the current ratio is super solid with 3.41. So the current assets are at slightly under 150 billion and the current liabilities are at just 43 billion. So this also is super solid and one of the best balance sheets in the world. Then take a look at the management of Alphabet. And there was a big change in 2019 because Larry Page and Sergey Brin just stepped down and announced they're stepping down, and Sundar Pichai just followed them. And I found this very interesting article about him on the BBC site, and I want to go through a little bit about that because this is really an amazing story. So he's a CEO of Alphabet now and following on Larry Page and Sergey Brin, which is of course not a very easy job to follow on the founders of these giant. They say the life story is just remarkable. He was born in India, in Chennai, and played cricket there, leading his team to different regional competitions. And he joined Google, or Alphabet, now in 2004. And he was also one of the creators of the Android mobile operating system, which is used by almost everybody who don't use Apple. According to a profile in Bloomberg magazine, Pichai's upbringing was humble. When he lived in India and raised up in India, his family lived in a two-room apartment He even didn't have a own room and slept on the living room floor with his younger brother. So this is really a nice story, and I think it's worth it to read a little bit more into that. When I read to all of that and how long he is with the company and how much he sticked with the company, I think Alphabet is in very good hands with this CEO. Then take a look at the price. Right now, Alphabet is traded at $2,467, and this is a long-term chart, and you just see that the stock price just rises over time. And the question, of course, is will there be even more growth, and will the stock price rise more? And is it the right time to buy in at Alphabet? Or when you look at this chart, maybe it's just too late and Alphabet is maybe overvalued right now. So let's check this. When you remember, I showed you before the Yahoo Finance estimates, and they just say over the next 5 years the growth rate will be around 6% per year. And this is really, really not much. And so I looked a little bit around and found this estimates on Simply Wall Street, and they estimate a growth of 16%. It could be more real because 6% is really, really not much. And 16% is also around the growth of the last few years. And so maybe this is more close to the truth. So let's calculate. So really take this more positive number of 16% growth rate first 10 years as I use the discount cash flow method and try to look 20 years in the future as a long-term investor. So let's say we take these 16% for the first 10 years, and for the terminal growth rate for the second 10 years we take 10%. And then we also have to put in the discount rate, and the discount rate, as I explained before, is just my expected return of the investment. And then take the current earnings per share. And in favor of Alphabet, I took the earnings per share for the whole year 2019 with $49.16. We don't have this special situation with the pandemic into that. We just take the full year 2019. So hopefully we come a little bit closer to the truth. And when we calculate that, then we come to a fair value of 1,232, and the current price, as I showed you before, is 1,467. So with this calculation, even with this very positive calculation, Alphabet is overvalued around 20% right now. Of course, this is really the positive thinking. When we would follow Yahoo Finance, of course, this would be much worse and the overvaluation would be even bigger. You can use the one or you can use the other, but at the end, Alphabet right now is overvalued. So what's my conclusion then? My conclusion with Alphabet is that we of course have a great company with a dominant market position, and they are still growing even when this growth maybe slowed down a little bit. And they just have a great business model and just have a cash machine. But, and that's a big but right now, for me as an investor, they are just overvalued as so many other of these tech stocks. It's not like we have a super big bubble with these FANG stocks, but at least they are overvalued, and at least 20% as I calculated. I think the truth is maybe even a little bit more. And so I will not touch them now, but I will still keep them on my watch list, and maybe in the next crash there's a chance to buy in this great company. Then take a look at my portfolio. And in the past week I got my dividend from Scotiabank, or Bank of Nova Scotia, of $57.24, and I got my dividend of AT&T of $34.48. So that's really nice, and every time I get some dividends I'm just happy, because this is really kind of passive income. And here we can also take a look of the dividends so far this year, and we just can see that this is growing at the start, and of course the compound effect not even kicked in. But at least that's nice. In July I got over $130. In June over 120, and let's see what happened in August. And of course over time this will compound. Yeah, will be just a nice cash flow of dividends. And last but not least, take a look at the performance of my portfolio. And as you maybe already know, I started this North American portfolio at the 2nd of December 2019. And so far, I have a performance of 19.9%, which is an outperformance to the S&P 500 of almost 14%, which is nice. It got a little bit less over the last few days with this tech run. My portfolio is not so much on tech stocks. I have a lot of old economy. With that, I'm even more happy to outperform the S&P 500 so far. And that's very nice, and we will see how this will go on over time. So that's it for today. If you liked the video, give me a big thumbs up, subscribe to my channel, ring the notification bell to never miss another video, and then we will see the next time, and then with another analysis of another stock. See you then, take care, bye bye.